Hey, this is Justin with DayTradeTheMarkets.com, and in this video I want to talk about a pretty big disadvantage that we all have to overcome as traders. It's something that's inherent in the way that the market works, and I think it's so important that I want to make a specific video about it, because if you don't understand this concept, what I'll be talking about later in this video, and if you don't get this right, you really are pretty much guaranteed to fail. The good news is, however, that if you get this right and you consistently do this trade after trade, you will succeed. So let's first talk about what the obstacle is. Can it even be overcome? If so, how? And to be clear, I'm not talking about the mental challenges that come with trading, though, although those are certainly real, and those are certainly things that we have to deal with and overcome and flow through as we trade and we progress our way through this business. And I'm not talking about anything like high frequency bots or market makers out to knock your stop or something like that. I think that's way overstated. I think those are just used as excuses by people. What I'm really talking about is something much more basic, just the general math of any given trade that dictates essentially that we face a slightly uphill climb on every trade that we take. And the reason I say that is because basically the way that the market works, our protective stops are market orders. Our profit targets are limit orders, unless you're trailing a stop, which, that's a different situation. But I just want to talk about this in general, because the idea is that we essentially start every trade with a 1 to 1.5 tick deficit, which doesn't sound like a lot, but it basically guarantees that if we were to randomly get into the market or flip a coin, guarantees we could lose. It guarantees that we will not win. So we have to find a way to overcome that. So randomly speaking, or hypothetically speaking, let's just say we get long here and our target is +6 and our stop is -6. Again, I'm not saying you would take a trade like that necessarily, just using a hypothetical example. So let's think about what happens. Well, if we got long, we bought it here, and instead of it going up 6 ticks, it goes down 6 ticks. What happens? Well, as soon as it hits -6 ticks, which is that range right there, as soon as it hits that distance, we are stopped out. It doesn't matter if it touches it for what seems like a microsecond and flips right back around, or if it goes through there, we are stopped out. And we can all relate, if you've traded more than 2 days in your life, we can all relate to a trade that goes down, touches our stop for what seems like no time at all, but bottom line is we're stopped out. Now compare that to the target side of things. Let's say the market goes, instead of going 6 ticks against us down there, let's say that the market goes 6 ticks in our favor. Well, what does that mean? It means that we might get filled, we might get our target, but more than likely we won't, unless a lot of volume goes through at our price, simply because the market a target is based on a limit order. So in other words, we essentially, to make 6, the market basically has to go 7 to make 6. It only has to go 6 to lose 6, okay? And again, that doesn't seem like a big deal, but right off the bat, on any given trade, we're essentially at a 1 tick disadvantage. Again, to make 6, it's got to pretty much go 7. Not every time, I understand that, but generally speaking, it's pretty much got to go 7 to make 6, or it's got to go 14 to make 13, or whatever the idea is, but it only has to go -6 to lose 6, okay? Now, when you add in the idea of commission as well, that's typically, a third of a tick, 40% of a tick. Just an example, on the E-mini S&P, if 1 tick value in the E-mini S&P is $12.50, and I pay less than 4, but let's just say on average we pay 4, it's approximately a third of a tick. Again, every trade we take, we're at that much of a disadvantage. In crude, let's say you're paying $4, each tick is worth 10, it's approximately 40% of a tick. So somewhere between, a tick to a tick and a half deficit on every trade, we start with that as a disadvantage. Now, does that mean that trading is unfair or that you can't win? No, not at all. It's just the nature of the beast. It's essentially like starting a basketball game down 5-0, okay? It can easily be overcome, but it is a disadvantage, and you better be good. If you're not a good team, you're not going to overcome a disadvantage in basketball. But if you are a good team, or in this case, if you're a good trader, you know what you're doing, you can certainly overcome it. So again, it's not the end of the world. It just shows us we have to be a little bit better. We have to be a little bit better than a coin flip, obviously. Okay, so if we have a deficit, if we have a disadvantage, how do we overcome it? Well, we need a competitive advantage. And I remember my dad telling me this when I was young, this basic quote. I don't know if it was Jack Walsh that originally said it, but he said, if you're ever in a business, if you don't have a competitive advantage, don't bother competing, okay? And it's the same thing in trading. Trading obviously is a business, and I certainly hope you treat it like a business, but you absolutely have to have some kind of a competitive advantage. Otherwise, you're going to get eaten up. And the competitive advantage is that you have to have a couple of things, and I'll talk more in depth about this in a moment, but you have to have the skill, number one, to identify, and then the patience to wait for what we call asymmetrical trading opportunities. Okay, asymmetrical trading opportunities. That's a key phrase. You want to really understand this. And there are basically two forms of asymmetrical trading opportunities. Okay, you can either have a trade with a very high winning percentage. Okay, so you could theoretically have a 1-to-1 risk to reward ratio, or even a 1-to-2 reward to risk ratio if your winning percentage is high enough. If you're hitting 60, 70, 80, 90%, you can overcome a pretty small risk to reward ratio. The other way, if your winning percentage is not 80, 90%, you need to have more reward on your average win than you have loss on your average loss. Okay, there's really only two examples of asymmetrical. You either need to have a high winning percentage, or you need to have a high reward versus the risk that you take. Okay, now the ideal scenario here, of course, one choice is high reward versus the risk you take. One is high winning percentage. The ideal scenario is that you have both at the same time. That's the old Venn diagram there. I think that's it really sums it up beautifully. The ideal situation, the best asymmetrical trading opportunities have both high reward to risk and a high winning percentage. Okay, and I would even go as far as to say that the ability to identify these asymmetrical trading opportunities is the true skill of trading. You cannot afford to be guessing. You must be able to identify the quality of a given opportunity. And when I say quality, think of that as in terms of a combination of the odds of success, okay, the winning percentage, and the magnitude of success, the profit expectation if you're correct, okay? And you must be able to identify the true amount of risk you would need to take for that given opportunity. So if we can identify how much of an opportunity, how quality the opportunity is, and we can identify the true amount of risk that we need to take, we can then put ourselves in situations where we're only taking asymmetrical opportunities, okay? And by the way, most traders get this wrong. This is something we talk about, is identifying the true amount of risk, okay? So when you think about this, really, if you think about it as the true skill of trading, it's almost edge 101, basic edge. If we have opportunity, if we can identify opportunity, and you can't just this is not a random thing, you have to have a skill to identify opportunity, and we can identify the amount of risk we would need to take, then we can always put ourselves in situations where the risk we'd have to take is worthy of the opportunity that exists. Okay, it's essentially the natural law of trading. Okay, if you are always day after day, trade after trade, getting this right, so we're always in situations where the opportunity that exists, we've been able to identify how good the opportunity is, and then if we always know how much risk we'd have to take, we can kind of do, it's like an algebra problem, right? Is this risk that I'd have to take worthy of this opportunity that exists? That's a skill. You have to be able to do that. But if you get this right day after day, you literally can't fail. That's how trading works. Most of us get this wrong. Now, the way that we apply this, and there's more videos on the site about this, is we'll look at a software that gives us an advantage to see under the surface of the market. Then we'll put the market into what I call boxes. From there, we identify trade opportunities, trade setups that are already high edge, but then we increase our edge even more by scoring the trades and being able to understand which trades are the highest expectancy, in other words, the best opportunity versus the lowest risk, and which are lower that we want to avoid. So again, asymmetrical trading opportunities, you must be able to identify them. That is the skill of trading. It's the natural law of trading, if you will. And if you get this right, you succeed. If you get this wrong, like most of us do, especially when we're beginning, it's inevitable that we fail because we face an uphill climb. So hopefully that makes sense. If you have any questions about that, let me know. And also please check out the other videos on the site to get more in-depth information about these concepts here. Thanks a lot.